In the lifespan of a business and our business clients, it's very rare that they don't come across a need for capital at some point, whether it be through equity infusion or borrowing money. It is a common practice area that we deal with all the time. We represent both private entities that are trying to borrow money or raise money, as well as banks and other individuals who are lending money. It's a very wide range practice of ours. And there can't be anything more critical to a business than making sure when they're bringing money in or lending money or making money available to other parties that those documents aren't exactly the way they want them to be and that transaction isn't papered the way that it should be. It's a very critical area of our practice. Eric, I know you work a lot in that area. Tell me a little bit about when you are handling a equity transaction or a borrowing transaction, the sorts of things that you talk to clients about.
Well, specifically, if we're representing the borrower, you're right. Companies need capital to exist. So the first real question is, what are you going to be using the money for? Is the capital being used for operations? Are they making an acquisition? Are they buying property? Are they buying equipment? Because that's going to dictate and determine the type of lending that's available. And as you mentioned, we work with a number of banks and different lenders in assisting clients in that area. So one of the first things that we want to look at is how this loan is going to be structured. Is there a period of interest only? Is there a period where there's a combined payment of interest for interest and principal? The biggest area that clients are interested in is the area of guarantees. Banks are not going to lend money without requiring a personal guarantee. So usually the principals are required to execute some type of personal guarantee, which essentially means you're on the hook. In the event the company doesn't pay, the individual is going to have to pay. One thing that we've been very successful at doing is getting those guarantees to burn down or essentially diminish. So initially they may be responsible for 100%, or they may be responsible for 100% of their interest in the entity. But then after time, after the loan's being paid down and the company is showing that they can perform, those guarantees will burn down or decrease in time. Our goal obviously is that our individual clients, the principals, are not going to be on the hook in the event that the loan goes bad.
Brian, I know you help a lot of times with the document drafting. When we're representing either borrowers or lenders in a transaction or equity partners, I know you do a lot of looking at documents and reviewing and drafting of documents. When we're representing those sorts of individuals, talk a little bit about the documents and what's important in those documents when somebody is either lending, borrowing money, or making money available to another party.
Sure. In any lending situations, one of the first things that you really need to hammer down are the details. One of the major loan documents is the promissory note, and that lays out all the terms of this agreement to lend money. So you're going to have the amount of the loan, the parties that are involved, the term of this loan, and any payback provisions. And then the other major consideration is the securitization of that loan. So that gets into the security agreements. What is going to be held accountable for this loan in the circumstance where the loan amount's not paid back in full? So you have security agreements that lay out all the rights and remedies of the lender and the borrower, and then there's also the consideration of a UCC-1 filing, which is the formal way of giving notice of this security agreement.
Eric, I know we do a lot of private placements where there are people looking for private money, not going to a public sector, but looking for private investors in their business. Tell me a little bit about what we do for those clients.
Sure, and that depends specifically on who the parties are that are going to be providing the money. If I'm going to a couple of friends that I know, we have a relationship, and they're interested in investing in the business, and I'm not going out and seeking or soliciting investors, then typically that can be handled through a contribution agreement or where they're buying equity in the entity. They're buying part of the business. If I'm actually going out and soliciting, and that's where you've got to be cautious because, of course, if you're publicly, if you're attempting to raise funds publicly, then that entity is going to need to be registered with the Security Exchange Commission, the SEC. But there are some exemptions from that, and it's called a private placement. So essentially those limitations are, it's limited to advertisements or solicitations within the state of Texas. The investors that you're discussing or seeking have to be qualified investors, and there's a whole series to go down. So essentially what it does, it opens up your potential lending base to some additional people, not necessarily people that you have personal relationships with, but there are some qualifications. They have to to be qualified lenders. You can't place ads in the paper and on the internet seeking investors, but it gives you a little bit more flexibility. And that's typically called a Reg D, where it's a private placement memorandum. A little bit more restriction, but it does open up the potential lending base.